Okay. Should we get started? What do you guys think? All right. Awesome. Well, thanks everyone for coming. My name's Eric Weiss. I'm really happy to be here. This is my second year talking at Convergence, so I obviously didn't screw things up too badly last year. But thanks so much to Caleb and obviously the whole crew here for putting together an amazing show. It's a real honor to be here. So what I'm here to talk to you guys about tonight is essentially how to ask for money and how to convey to investors that you kind of have your act together, right? That you have more than just an idea, but you're an established entrepreneur, that you're well prepared, that you're knowledgeable about your domain and so on. So we'll kind of go through some of the pre-work that you need to do to prepare before you speak to any investors. We'll talk about kind of the basic structure of an investment pitch, and then kind of dive into some of the nuances. And I'm going to try to focus on kind of the pitfalls, the cliches, the things that investors are looking for to kind of filter you out, right? So, investors are looking at, dozens and dozens of investment pitches all the time. While you, of course, are a special snowflake, they get to see the whole blizzard, and so you want to figure out how to stand out. So who am I? I am a consultant. I've been in tech a really long time. I was CTO of a company called Rock My World. I was CTO there for about 5 years, but before then and since then, I've been consulting for startups and mid-size and large companies, focusing on product strategy, leadership, and agile development methodology. So I like to help founders get through their growing pains and kind of get to that next level of maturity. And where that ties into investments, obviously I've been through several engagements myself and investment rounds myself, but kind of helping companies that are gaining traction, that are prepared to grow really explosively, and they just need that injection of capital to get to the next level. So let's begin. So before the pitch, right? So like I said, you guys need to be prepared before you go and ask for money. And so the first place to start, I had to think about where do we really begin? It's what's the purpose of your company? The first thing investors are going to look for is this a solution without a problem? Are you someone with an idea but doesn't really have any backing in reality? What they're really looking for is somebody who's really driving towards a cause. They're really connected to some group of people trying to solve some really significant problem. And they've come up with some creative solution to do so. So this is a book that is popular in the sort of startup world, and something that I recommend. But starting with your fundamental purpose, who you're trying to impact, how you're trying to change the world, essentially, before you even start on what your product idea is. Okay. Then I recommend starting with a lean canvas. So how familiar are you guys with this? Has anybody ever done this before? So it's a one-page business plan, essentially. And on one sheet, you're basically going to be able to answer all of the critical questions that any investor is going to ask of you. So if you can't fill out this sheet, don't even get started, right? You're not prepared yet to go ask for money and get to that level. So there's tons of resources out there. You can Google it. There's books on this. There's tons of videos. So this is just a very ubiquitous sort of tool that you can use to just kind of flesh out not just your idea or the product, but all the fundamentals around your business as well. Okay. Then I'm a big proponent of user-centered design. I believe in starting with a purpose, starting with a sort of user group, a niche, really deeply understanding their problems, gaining empathy for them, and then collaboratively building solutions to their most significant problems, right? So again, problem first, people first, and then the solutions sort of organically grow out of it. I did it, actually, the talk I gave here last year was completely focused on user-centered design, so if this is something you're interested in, let me know, and it's online, there's a video of it. But essentially what you do is you do a lot of research into the problem domain. You try to understand, you create the journey map, you try to understand the problem they're having, the solutions that they're using today, where those solutions fall apart, and where are there opportunities to create something new that solves that problem better for them. And then you just iteratively create from sketches on napkins to gray wireframes to clickable prototypes to functional code that increases in scope to an MVP and beyond. But you essentially are increasing fidelity on what's working, and you're discarding what isn't without spending $1 on something that isn't going to be viable in the market. Okay. So that is kind of the pre-work. Now there's something, again, in between here and the investment pitch, and that is go build your product, bootstrap it, friends and family, self-fund it, whatever you need to do, get traction, and actually show that you have a viable business model before you go ask anybody for money. So there's two reasons for this. One, the days of people getting funded off of an idea are largely over. There's a ton of startups out there. Investors are more risk averse now than they were. We're not in a full-on bull market with respect to tech, and so they are really looking for traction, and they want to see that you have skin in the game. So you get to a point where you're ready to ask for money. Okay, you've built something, you've shown that the idea is valid, you've shown that there's a need for it, you've shown that you're solving a really significant problem, and now there's this opportunity out there, right? All we need to do is just buy advertising, or we need to build some big integration, or there's something out there that you just need this injection of capital, and then you can achieve this this really large opportunity out there. That's when you go and ask for money. So even something small, right? Even at at the angel stage, or a bridge round, whatever it is, even for small amounts of money, they want to see that their money is going to be put to a specific purpose. They're not a patron, of you as a creative, as an entrepreneur, to help you kind of fund and build this whole thing. They want to see that you've put everything that you've got into it. There's this gap that you just need to cover, and with this specific amount of money, you're going to be able to get there, right? Okay, so now you're going to get up and you're going to ask for money. Okay, so you might be on stage at a pitch competition, you might be in front of an angel network, or you may be meeting with VCs or beyond, right? So depending on where you are, depending on your audience, and also depending on kind of the stage of both your company, but then also the level of negotiations you're at, you're going to have to adjust your pitch. Okay, so if you're at a pitch competition, you're really focusing a lot on the story, right? It's a lot of flash, a lot of sizzle. You're kind of selling yourself as the entrepreneur. You're selling the concept. You're selling the promise. But then later on, or with more mature investors, it's really going to be around the business model, the financials, the KPIs, and so on. So you're getting in front of this audience, and obviously at a pitch competition it's difficult, but at any other organized investment pitch, you're going to want to know every single person in that audience, who they are, what's their background, as much as you can know about those people, so that you can tailor your pitch to that. So know their level of technical expertise, know their level of domain expertise, right? Don't get down in the weeds in some area where you're going to lose people, where they're going to get glazed over. Understand whether or not these people are thinking sort of emotionally or rationally. Again, are they buying this because it's cool, because they think it's the hot new thing, or is it they're looking for a very logical sort of business model, right? That also even depends on your industry as well. And then have a very clear objective. So know what you want to get out of it, and kind of when you close it, say, this is exactly what I'm going to do. This is exactly how much money I need. This is exactly what I'm going to do with that money. And you can come along with me on this journey. You can be a part of it, right? That's how you kind of wrap it up and get people on the hook. Okay. So this is just the basic sort of recipe or ingredients, if you will, of a boilerplate pitch deck. There are tons of templates online, and you can find examples of pitch decks from great companies like Airbnb and Slack and all those sorts of things. So obviously you want to do a lot of research. And again, you're depending on the environment, you're going to pick and choose and sort of add emphasis where is necessary. But in general, right, the kind of the story arc goes, there's this intro, there's this founder story. Who am I? What's my pedigree as an entrepreneur? how I discovered this sort of problem, how I'm connected to this group of users or group of people. And I started to really understand that there was this problem in the market that wasn't being fulfilled. There are some solutions that are out there that aren't really doing the job. And I came up with something. Here's the solution. And here's why it's better than everything else. And here's why it's going to solve such an important need, what have you. And oh, by the way, this is applicable to a very large market. And then these are the other competitors out there, large and small. This is how we're going to build the product, not only in key features, but in sort of the evolution, right? Product extensions, adjacent markets, these kinds of things. What's our business model? So how are we going to make money? How are we going to grow? What type of outside to sort of services, or what other market forces need to kind of go our way to support it? How you're going to use that money, how you're going to put it to work. The team is not necessarily last. I tend to see it kind of last, but some people put it up in the front. But it's essentially they want to see that again, you're an entrepreneur, that this isn't your first rodeo, that you have a track record building and running companies, but then you also have a really strong team of people around you that are equally committed, equally passionate, equally talented, well connected, and so on. So that shows that you are the right team to solve this problem. Great idea, big problem, novel solution, solid team to get it done. Yeah, you have a question? If it is your first rodeo, you have a little bit more of a challenge ahead of you. No, I wouldn't say so. I think you definitely want to rely on your domain experience. So I would say if you're a first-time founder, you can make up for that by being really, really knowledgeable about the business area, right? So you've been working in this industry for so many years. You've got a lot of connections. You have a lot of the stuff that a founder would need. You just haven't been through the process of being a CEO before. And so then probably what they would like to see is that you've got a really strong advisory board, right? They're going to want to see that you have people that have that that history, that are veterans, that are there to help you along the way. Ideally, that they're actually early investors. Somebody that who's well funded, or not necessarily well funded, but at least a seed investor who knows what they're doing, who's sort of committed to coaching you along the way. But yeah, there's obviously a lot to running a business well beyond just the product itself, and somebody on your team needs to have that experience. Yeah. Okay, so well, actually, before I go on, any questions here, or is there anything big that you think I missed? Yes.
The go-to-market.
Yeah, go-to-market strategy. That's kind of wrapped in product, business model, and so on. But yeah, you're absolutely right, and I actually it's one of the areas I focus on. So I probably could have called it out explicitly, but yeah. Anything else? Okay. Okay, so the founder story. Like I said, it's more important at events like a pitch competition or at an angel event. VCs aren't quite as interested in it, but the idea is that you are you're showing that you have charisma. You're showing that you're capable, that you're prepared, that you have a lot of domain experience. Ideally, that you've gone through this before, that you're not a first-time founder. Show that you have some really deep connection to the customers, right? You feel their pain, you empathize with them, whether it's you or someone very close to you. Not only to show that you really understand them, but that you actually have access to them. Because especially when you're building a new product, you need a lot of feedback. Especially as I talked to around user-centered design is all about user feedback. So you need people that you can reach out to constantly that are not going to ghost you eventually because you're bugging them too much, right? And then you tell the story about how you discovered this solution, and tell some compelling story that said, so essentially what you have to think of is the investor is coming from a place with no information, no context, and you have to get them to the point where they say, aha, I get it, right? And so you have to very succinctly kind of get them from that place where you were when you didn't know anything that was going on to the point where, oh, okay, here's how this all started to kind of take shape. Okay. Probably the most important thing, in my opinion, that you need to really nail is the problem domain, right? So there is nothing, there is no solution over-engineered enough that can be successful if there's no problem, right? And if there's a huge problem, a severe problem, you can make a kind of a mediocre solution and still be financially viable, right? So what they want to understand is how severe is this pain to the potential customers? How many people are experiencing that pain, right? It's a large market. The severe pain means they're willing to pay for it, right? And if it does a good job, it means they're going to tell other people and so on and so forth, right? If the problem just isn't that big, you're going to have a hard time monetizing them. They're not really going to be promoters. They're going to jump ship as soon as they find a better opportunity that's a little bit cheaper, what have you, or they just do nothing, which is kind of the inertia. You want to look at, what are they doing today to solve the problem, right? What solutions are out there, whether they're high tech or low tech, right? What are they doing to try to solve this problem? And then really drill into where those solutions fail. The key detractors of these existing solutions. Okay, and then you lead up. Okay, you unveil the solution. Right. This is how we're gonna nail this thing. This is how we're gonna solve this problem. Now, investors are, let's just say, a lot of times they go with their gut. There's two things that I believe, this is my opinion here, I believe that investors are making their decision off of two things. You as a founder, do they just like you? Do they connect with you? Do you have charisma? And do they just intuitively get the idea? I've seen a bunch of investment pitches, and I've seen people say, yeah, it was really cool, and I just didn't get it. Or just didn't fit in my world, or I just didn't relate to it, right? And so you need to make sure that they get it very quickly, so you need to be very clear, concise, succinct, and go right to, okay, you understand the problem, you understand the gaps, this is the new solution, and here's how it fills all of those gaps. With some clear user benefits, right? So don't talk about features, talk about benefits. Let me just pause there for a second, because that's a really important thing. Don't talk about features, talk about benefits. When you explain your solution, explain it from the user's perspective. That's how they're going to get it. If you're talking about features, if you have your sort of engineering mind, if you're presenting from that perspective, then they have to make the logical leap to say, okay, how does this feature solve the problem, right? You want to take it from that other perspective to say, we're going to do something, here's what it's going to do, basically high level, but here's how we're going to resolve these problems and the benefits the users are going to receive. How is it different from other things in the market? And then timing. So why now? So one of the things that investors are always keeping in their mind is, well, if this is such a great idea, why hasn't it been done already, right? This is such a fast-moving market. Very few ideas really sit on the vine for very long. So there's something about this. If it hasn't been done, either you are right on the cusp, you are coming up with something that you are the first person to think about this, which is very rare, or there's some other problems here, right? And a lot of times the timing factor comes in as a justification, if you will, where it's you're saying, well, there's this established player, it's ripe for disruption, and here's this insertion of some new thing, a new technology, a new platform, it could be some socioeconomic factor, it could be something, some market force that all of a sudden opened up this opportunity now for the first time, and you are right on the cusp. You don't want to necessarily be the only ones doing this, right? You want to show that there's some competition, but that there's nobody who's really, eaten up all the market share. Any questions here?
Just a comment that competition is validation.
There you go. Exactly. Competition is validation. Okay. So, that's the kind of the intro, you're kind of setting the hook. And now we're getting into kind of the model, right? So now we're really starting to flesh out how this thing is really going to work. So you start with, this is kind of a common slide around the market opportunity. So you want to show that there's a big market, that you can, there's a certain amount of market you can capture today, but with growth and product line extensions and so on, that you can expand into other markets. Is this familiar to everybody? How many of you have seen something like this before? Okay, good number of you. So I'll just explain it real quick. So total available market is basically your entire industry. So let's say, for example, let's take Airbnb. So Airbnb is in the lodging, or you could say hospitality market. Okay, there's a lot more to lodging and hospitality that Airbnb could never touch, but they're in this industry. Okay, that's your total addressable market. Those are the people that are sort of interested in you, that maybe there's some opportunities in. This is the space you're playing in. The serviceable available market is essentially the total addressable market sort of scaled down to what is relevant to your specific space. So, not only home sharing, but even like hotels or lodging or something like that. And then the obtainable market is what you can reasonably capture either with your existing product or with, let's just say like in the next year, 2 years, something like that, right? So with a reasonable amount of effort and capital, there's this obtainable market, and then beyond that, there's this available market that you could eventually grow into. Okay, so pitfalls here. This is one of the places where I think there's a lot of cliches, and a lot of people really kind of try to get a little too greedy, a little too eager here. So don't include irrelevant segments. Right, so don't try to inflate these industries artificially, because the investors will sniff it out, and you'll lose credibility. Set reasonable penetration targets. So this is a big one. I think again, people get greedy and they say, "Oh, we're going to take over 50% of this market in 2 years, whatever." Totally unreasonable, and it shows that you're an amateur. Actually, I was just looking at a few companies today, but Airbnb now has a gigantic company, right? Market leader. They have 8% of the lodging industry. So as big as you can get in a sizable industry, single digits, high single digits is actually a really sizable market share. There's sort of two ways to slice this. Either you want to get a big share of a small market, or you're going to get a small share of a big market. So yeah, set your sights a little more conservatively. And then tie it back to the investment. So like I said, you're here today for a very specific purpose, right? You've got you've built a product, you've got some traction, you have a need. There's a something in your sights that you want to get to, and this investment is going to get you there, right? So you're saying like, today we've got this market share, but with the investment that you're going to give us, we'll be able to achieve this market share in 12 months, something like that, right? So everything kind of needs to be honed down into, again, why are you here today? Don't just be completely pie in the sky and say, by 2030 we're going to just be this gigantic multi-billion-dollar company. Set your sights, on the present. Okay. All right. So we've kind of explained sort of what the product is. That there's a big opportunity here. Now we're talking about strategy. How are we going to execute? And again, this is where you are showing that you have, as an entrepreneur, that you've really thought this through, right? That you've gone beyond just the idea, beyond the concept, and actually thinking about how is this thing going to become a viable business? How are we going to grow? What are our stages of growth, and so on? That's maturity. So product strategy is basically all about what game are you playing and how are you going to win? Right. So understand, are you going to be, are you going to go head to head? Are you looking for, an untapped market? Are you going to be going after, the big whales or the small piranhas? So this is a model I like to use to kind of illustrate, just with all my clients, we just do this landscape. Well, what does your competitive landscape look like? So you've got some dimensions here, all depending on your industry, and then you've got players all over the place along some different axes. And you've got your whales, which are just the big players, and they've just eaten up a bunch of market share, and they're really hard to unseat, right? You're really not going to want to go against them head to head, but they're also really inefficient at targeting specific niches very well. So they're mass market, mass appeal, everything is kind of sort of spread thin. And there's an opportunity here to maybe carve out a piece of what they do and do it better, become a market leader there. In other cases, you have the piranhas. So I look for, these small sort of commodity players. They're not differentiated from each other, and they just compete on price. And that's, again, the last place you want to be, because that's just a race to the bottom. You're not going to make any margins, and investors aren't gonna talk to you. So what you really want to do is show that, hey, there's some area here, there's some niche that's untapped, right? We're going to be differentiated somehow. We're going to kind of skirt under the radar, and then ultimately the idea being that you get acquired by one of these whales. Okay, and really focus on where you can be the best. Okay, so what is it that's in your unique, your unique makeup, your unique connections, your domain expertise, specific features around a product? Where can you really be the best in the market? Because all these other forces are really just not where you want to play. It's going to be muddy. Okay, this is what we were talking about, go-to-market strategy. So the idea, I like this model. And I don't actually recommend you sort of put this in a pitch deck. I mean, you could, maybe later stage, but this isn't something you'd get up on stage and talk about your bowling pin model, right? But this is an exercise, a tool that you definitely want to go through to kind of visualize how is your product going to evolve. And so there's two axes here. The idea is that you're going to hit the first pin, right? And if you really nail it, then these other pins are going to fall much easier, okay? And the two axes here are, you're going to have one market segment that you're going to continue to capture more and more market share as you add more features and gain growth. And then on the other axis, you have adjacent markets, right? So something that, maybe with a little bit of tweaking, a little bit of product line extension, you can capture these other markets as well, and that's how you become a large growth company, right? And to kind of see it in these stages. Well, today we can go after the small niche, but if we do these few things, then we can go after this other market. Or, we think we can start unseating these other competitors if we're able to, achieve this, right? Okay. Your biggest competitor is doing nothing. And this is something that you absolutely should not take for granted. Too many founders, too many investment pitches that I see, they're so focused on the technology, they're so focused on being the greatest technology, especially in a new market. They say, wow, it's green field, it's wide open, right? But investors are always saying, well, why? What are they doing today? And why hasn't anybody been able to unseat whatever their current model is? And so the issues may be, the solutions are overly complex, or they're very expensive, or the most important one, I'm going to bust out my laser pointer here, it's not a big problem, okay? I can't stress this enough. If you're building a product and you and all of your competitors are unable to unseat some low-tech solution, it means that it just doesn't matter to these people enough, right? It's not a big enough problem for them to go through the learning curve or to pay money or what have you. Perfect example I deal with all the time. So in healthcare, I have several healthcare clients and everything around electronic health records and e-prescriptions and things like that. Their biggest competitor is paper, right? The doctor and their notepad and their scribbling, and that's how they work. That's how they've always worked, and it works and it does what they need it to do. And in almost every case that I've seen, companies that try to get into this space, what they find is that they actually make the doctors' lives worse because they're spending more time working with clunky solutions. You might be in this. Anyone who's seen this knows how difficult this is. And so, they go and try to capture these practices, and they say, God, we tried something like this before, and it's just so cumbersome, and I spend so much time focusing on filling out the fields, and I'm not spending time with my patient, and it's actually creating a detriment. Sure, you've got you're optimizing the back end or whatever, back office, but you're actually making their lives worse. So, long story short, make sure that so understand what are the low-tech solutions that are out there that you're competing with, and make sure that they are front and center along with any other competitor that you have. And again, this just shows investors that you've really thought this through. Okay. This is an interesting model that I like, that I've used, talking about how you're going to capture a market. So it doesn't really have a name. You can call it like, mice versus rabbits or whatever, but it's like 5 ways of making a $100 million company. It's kind of a new model that a lot of folks are writing about. There hasn't been like a book yet, so nobody's kind of coined it. But it's something that I really like as a way to convey to entrepreneurs sort of, well, what kind of business are you going to be? And then what specific strategy do you need to put in play? So the model is this. you can either be hunting flies, mice, rabbits, deer, or elephants. If you're hunting flies, these are essentially, you need 10 million users where you make $10 a year off of them. So these are your social media networks, right? You're mostly making ad revenue, and there's a specific strategy around that, which is essentially it's all about, it's all viral, it's all about creating communities, and you're basically funding it by ad revenue. Okay, mice. So you've got 1 million customers making $100 a year. So this is your Dropbox and your Netflix and things like that. They're really based heavily on referral fees or referral incentives. So you don't have a sales force, anything like that. You're starting to pay for advertising because the lifetime value is starting to make sense now, where you can actually try to target individual users. But yeah, so there's enough money to start maybe buying Facebook ads. But really where your growth is going to come from is saying, hey, if you sign up your friend, get a free ride or get a free, meal delivered or whatever it might be, which I'm sure you guys have seen a lot of at this level. And then as you kind of move up the curve, you're moving more towards enterprise. And so then, you move into having an inside sales team and an outside sales team and so on and so forth, partners and distributors and so on. So this is just a really good model for you to, again, not necessarily present, but to know exactly where you stand. And in terms of your go-to-market strategy, take from this, know where you are, where you're playing, and what what tools you're going to put in play to capture the market. One of the biggest pitfalls that I see, just as a bit of an aside, is there are a lot of fly hunters that think that buying ads, buying users is how they're going to grow. And it's a terrible model, and investors are going to crap all over it, right? Because they're just too expensive to buy. What you really want to see is a model where your cost to acquire new users is less than the revenue you're going to make from those users, and so the investors can just pour gasoline on, right? That's what they really want to see. They don't want to say, well, if we go out, we spend a bunch of money and we buy these users, but we buy them at a loss, we'll get some critical mass and then we'll take off like a rocket ship. It's not going to fly, right? Okay. How am I doing on time? All right. So traction. This is probably the second most important aspect of your pitch, is again showing that you've built something, it's viable, your customers love it, and that they're really engaged with it, they're telling their friends, they're spending money, things like that. The first way that I would recommend, this is really tied into kind of, again, the user-centered design methodology, create a landing page, pay a designer to do it, make it nice, make it clearly convey the problem, the solution, right? With a little email sign-up form at the bottom. And then buy some Facebook ads. Spend $100, target it, and just kind of see what your conversion metrics are, right? So what's your reach, what's your click-through, and how many people are converting to giving you their email address. This is a great, super cheap, super early indicator before you've ever built a product, just to validate the idea, to see if there's interest and if it's resonating with people, okay? Now you've got those email addresses. Now these are your beta users. These are your early adopters. So now you can reach out to them as you start to flesh out this idea, and you can survey them. You can say how are you experiencing this problem? What solutions are you using? How much are you paying for these solutions? How much would you pay for this concept? And so on. And then as you build prototypes, you're sending out these emails, these incentives, maybe throw them a gift card here and there, that kind of thing, right? So for very low cost, you're able to validate an idea and increase fidelity on it over time. Okay, and then once you actually have a product, you have to prove that your early adopters really love you. If they don't, right? So your early adopters are the ones that are really going to give you a shot, right? They're not going to abandon it. They're used to clunky technology and so on because this is something that's really vital, really important to them. After that is where it gets a little bit, gets a little finicky, right? And so you really want to show that your early adopters absolutely love what you do. So track your engagement metrics. How many of them are using your app, using it regularly? How many of them are paying you? How many of them are referring? What's your viral coefficient and so on? And really show that this thing has legs even at a very small scale, right? And all you need now is funding for it to grow and so on. With a final caveat that your data creates your reality. Okay, so if you if you're just selling an idea, it's it's all promise. And again, I contradict myself because not a lot of investors will invest in purely an idea. But the more data you have, that's your graph, right? And that trend is going to follow that curve. So you just need to be careful that when you're just starting out and you're collecting these metrics, that you're making sure that you're really doing your due diligence and making sure you're delivering a solid product, even if the scope is really small, really whatever, well defined. So what that means is, build an MVP, limited feature set, but make sure quality's high, right? Don't let this thing be a buggy mess, and fall over yourself with customer service, right? Reach out to them personally, chat with them, talk with them on the phone, meet with them in person, do anything you can to make them feel like they want to help you, they want to support you, they're going to come back and use your app and so on. Kind of, nudge the data in the direction you want it to go when it's small enough that you can actually have an impact, right? Because once the thing takes off, or once that kind of, once it's been out in the market for long enough, again, that's your reality. Okay. So financial forecasting and just sort of modeling in general, this is where it kind of separates, the rookies from the veterans. Okay, and this is where an investor is going to look at you and really pick apart whether or not you're a seasoned investor or even just somebody who really understands the business that you're in. Okay, the first failure that so many founders do is they have this hockey stick. Have you guys seen this before? Yeah? How many of you have presented a hockey stick at some point? Yeah? Okay. So unless the hockey stick is in the past, meaning you've gone to that inflection point and this is your real growth, investors just, they're going to sniff this out immediately and they're going to say, come on. You're going to say, oh, well, our graph looks like this and, we've got this meager growth, but, then we're going to release this new feature with your money or something. All of a sudden, it's going to go into the stratosphere. It doesn't work that way, right? Everyone knows this is a tough road. And again, any entrepreneur that's done this more than once knows it's a tough road. So have, optimistic but somewhat conservative estimates, right? Just be realistic in how you're forecasting. And most importantly, know your KPIs, okay? So know that you understand the drivers of your business. So a little bit of a quiz. How many people, who knows what CAC is? CAC. Just call it out. Customer acquisition cost, great. LTV. Lifetime value, good. ROAS? Awesome. MRR? I should probably repeat these because not everyone's on. Okay. Customer acquisition cost, lifetime value, return on advertising spend, monthly recurring revenue, churn retention rate. Okay, I'll just explain it. So churn rate is essentially how many of your customers you're losing in a given cycle. Retention rate is sort of how long you typically keep a user around. Your margin, obviously, you have to show that you know what your expenses are, you know what your revenues are, and that you have a margin that you can track over time, right? So remember, cash is king, and they want to know that you know how to probably more than anything, they want to know that you're going to be managing the money they give you effectively, right? You're not burning it on, Lamborghinis or whatever. Okay, finally, DAO. What's DAO? Daily active users, monthly active users, okay? So, how many people are using your app at all? Monthly is kind of like just if they exist, they're, going to hit you at least once a month. Daily active users, obviously, who's using you every day. They're both important on their own in terms of size, but the DAO-MAU ratio is showing just how engaged they are. They're using it every single day. So however many users you have, if this is close to 1, they're using it all the time. That shows really strong engagement, right? So in terms of the modeling, you want to show that your LTV is greater than your CAC, right? And that's, to be honest, if there's just one thing that you can show, is like we can acquire users, and lifetime value, it kind of encompasses some of these other things, right? It's we can keep them around for a certain amount of time, we can generate a certain amount of revenue from them, and so you spread that out on average. This is our lifetime value. And so if your lifetime value is greater than your CAC, that means there's a positive return, and that means that whatever that return is what the investor can expect. And then you say, just pour gasoline on it, pour money. The more money you give me, we're just going to multiply that difference, and we're making money. We're in business. Okay. So again, depending on where you are. Obviously, you're up on stage at a pitch competition. This can be kind of sparse, but as you go through the process of meeting with investors, especially when you're really sitting around the boardroom and talking term sheets and stuff, you need to show them that you really understand this. You understand the financials of your business. Okay, cool. Doing really good on time, actually. So the team, again, as I said, you want to show that that you're somebody special, that you're dedicated, that you're committed, that you have experience, but then you're also surrounded by other people like you that are equally committed, equally passionate, equally talented, and so on. And include your advisors and mentors, just everybody that you can draw on that provides a unique mix-up of people that makes you uniquely capable of accomplishing your goal, right? And a lot of folks say it's kind of a trope that investors really do invest in the team more so than anything. If you have a super solid team, imagine you're a veteran entrepreneur, you've had 10 exits, you're a multimillionaire, what have you, and you come in with some idea that's just totally out there, you're still going to get people falling all over themselves to invest in you because they just assume you're the expert, you know what you're doing, you can make turn water into wine, right? And on the other side, obviously, if you have no experience, no connections, it's just you don't have any co-founders, you don't have any mentors, you don't have any advisors, but you have got this idea that's just going to change the world, then guess what? The other person who does have all those things is going to come and eat your lunch. And those are the people that they're going to be looking for and investing in, right? And then the last thing is around pigs versus chickens. Does this ring a bell? Do you guys know what this is? So you're eating breakfast, you're having bacon and eggs. The chicken is involved and the pig is committed, right? So you want to show that you're a pig and that everybody on your team is a pig, meaning you've got skin in the game. You've invested your own money. You've put your sweat equity into it. You're willing to take very little salary or live off of ramen, or you've been doing so for so many years, right? That's what they want to show because, again, when things get tough, and they do get tough, they want to know that you're not going to pull the ripcord and leave them, holding the bill, right? So then to kind of close it up, you want to round up with the promise, right? To say, okay, I've taken you through this journey, I've painted this picture for you. And this is what I'm going to do. I've got this thing, I'm working on it, there's this opportunity, and whoever in the audience, whoever comes, you sell me, right? If you come to me, if you can be a part of this journey, and this opportunity's there, it's waiting for you, the brass ring is there, we're gonna get it, and it could be you. That's what you want to kind of sell them. The ask being very specifically, just, I'm asking for $100,000 in exchange for 10% of my company, right? Just the Shark Tank kind of pitch, right? Just, what are you asking for? What do you specifically want? And that's your closing. And the last thing I just kind of threw on there is have your backup slides ready. So the pitch is sort of phase one. Phase two is going to be when they tear you apart, right? You've got to paint your rosy picture, and now they're going to say, all right, now let's dig into the details, right? They're going to start challenging you on things. So the pitch that you give may be high level, may be rosy and whatnot, but have your backup slides ready. Really be prepared to answer some tough questions. Practice it, with your friends and colleagues, whatever. Obviously, practice makes perfect. On average, I don't know what the number is today, but you're going to go through dozens of pitches on average before you actually land. In my case, I think we did somewhere in the range of about 50 presentation, doing the same pitch 50 times before we finally landed a round of funding. And so, you want to be, you want to be honed, you want to be prepared, you want to know what you're talking about, you want to have your information to back it up. And that's it. Before we get into Q&A, I just want to say, obviously, thank you for your time. Please connect with me on LinkedIn. I like to be an active member of the community. Happy to help make connections anywhere that I can. Follow me on Medium. I write about this stuff in detail. I write these sort of very practical how-to articles about this stuff. I have other conference talks and videos and stuff that I can share. And then obviously, as a consultant, if anybody that is going through growing pains and needs some level of maturity to their process, their leadership, or their product strategy, I would love an introduction. So thank you very much, and I'm open to questions. Yeah. Okay, question?
I apologize.
Yeah.
Would you be sitting that out, or could we ask for the slides that you showed tonight, or maybe I missed that?
Yeah, no, if you connect with me. I don't necessarily know where to send it, so yeah, if you connect with me on LinkedIn, I can share the slides for sure. Yes?
Do you have a different strategy for how you present the industry or the firm?
Yeah, definitely. Yeah, so the question is, different strategy for different industry or different firm. I kind of alluded to it that, in some cases you're selling the sizzle. In some cases you're just selling a money-making machine, right? And again, back to that kind of early slide, know your audience, know what you're there for. Typically, especially at a pitch competition, and also a lot at the angel stage, you are really selling the story, kind of the promise. It's obviously very early, so can be kind of pie in the sky. But certainly in certain industries, right? I mean, whatever, healthcare, what have you, and especially at the VC stage, investors tend to be more shrewd. They just want to see that you have a really solid business model. And if it's in the relevant industry and it's making money and you've got a strong team and whatnot, then they're sort of less concerned with your charisma, if you will. Yeah. Yes.
If you're in a position like me, and it is your first rodeo,
Yeah.
and you don't have resources,
Mm-hmm.
and you maybe don't have a business degree,
Mm-hmm.
but you have a good team, you have a great product,
Yeah.
you have a good business plan,
Mm-hmm.
how much does it matter that you have those negatives?
Yeah.
Is it still viable?
It's definitely still. I mean, certainly, every second-time founder was once a first-time founder. The first time is definitely more challenging. There's a lot to learn in the nuts and bolts of building a business that just go so far beyond the product itself. But again, so I would say network, find mentors, find advisors. Dive into this community, right? You guys are all here. Many of you are at the same stage, or there's definitely a cohort of people that are in the same stage, facing the same problems as you. So like join an incubator for one thing. So we were a part of Evo Nexus, and we were in this cohort, and we were just every time in fact, where a lot of this information came from is literally like me sitting in the office and another founder coming over and be like, hey, Eric, do you mind? Like, can I grab you? Can I buy you lunch? And I just want to go through my pitch with you. And we tear it apart, and we're going, we're critiquing everyone and so on. So just that practice and understanding each other, you guys are all kind of in this together. So that's what I would say, just lean on the community and learn. Do everything you can. Read books, go to conferences like this one. Just accumulate as much knowledge and experience as you can while you're doing this. And yeah, you're going to learn a lot of it on the job. The other thing I'll say is just build it. Just invest as much as you can, psychologically and financially afford, and get yourself up to that level of maturity before you're really ready to take on other people's money, because things change. When somebody else is investing in you, you have an obligation to them. They have more influence on what you do, and it's an unfortunate truth that when you get investors, they may fire you and replace you with somebody who's more experienced. And it happens. There are founders that lose their companies all the time once they get to a certain stage because they didn't level up fast enough. So, yes.
A lot of this information seems like it could come at various stages of your business development. So,
yeah.
Not when is the right time to look for investors, but at what point would you think you have all this information in a place where you could put something else?
Yeah. Well, again, I would say wait as long as you possibly can, right? So, the longer you're building it on your own with your own money or your own sweat equity, the more traction you can gain, and the better terms you can set when you finally do meet with investors. The more prepared you can be, right? The more leverage you have. So, kind of the short answer, it depends. But as long as you can afford to wait, and again, what you don't want to do is go get investment because you're going to crash and burn otherwise, right? Nobody wants to invest in a sinking ship. So you want to invest in a point where you're saying, man, we're really rolling on this tiny little loop here, but gosh, if we just could expand a little bit more, we could capture all these opportunities. A great thing, if you're, maybe not in software, but say, we have orders that we can't fill. We can't produce fast enough or something like that. Those are the types of things where investors are looking for that opportunity. Yeah, I hope I answered your question. Other questions? All right. Thank you very much. Please connect with me if you have any more questions later on.
Wunderbar. All right, one more hand for Eric Weiss, everyone. And so the
This
next
guy as well.